Today I want to go over a strategy that I use quite a bit each year. I probably place between 6 to 12 or more of these trades a year, all in the ES. It is a more sophisticated, and by that I mean high risk, and you need to know what you're doing and understand the options before you place these trades type of strategy. But it is, from a percentage standpoint, it's very profitable. It's profitable about 90% of the time. There's only a limited number of times each year that I have to even make adjustments on it. But you do have to stay on your toes. You do have to understand that if you need to make an adjustment, you need to make them. And you need to understand the risk behind these trades. These trades are all done, as I said, on the ES. And it's all done using an option strategy called a strangle. Now, a strangle, again, is an aggressive, unlimited risk type of trade where you're going to sell an out-of-the-money call and you're going to sell an out-of-the-money put with no cover, meaning that, again, your potential loss is technically unlimited on these. I would say probably your greatest potential loss would be to the downside, as markets can collapse faster than they go up. Although over the past couple of weeks it's been pushing higher and higher. So it is something you have to watch for, have to be careful of, and understand the risk. A more conservative play would be an iron condor, very wide iron condor. The advantage to the strangle over the iron condor is the strangle is easier to adjust, and it also you can make a higher credit on it because you can close it out a little bit sooner as it moves toward each position or away from each position. However, unlimited risk. The iron condor, if you do that one, you do have capped risk, so you know the most you can lose, and certainly that's a strategy you can use on indexes. If I was doing an iron condor, I would probably use the SPX as opposed to the ES, but for the naked strangles, or for the strangles, I'm pretty comfortable using just the ES. Now, what we're looking at here on the screen right now is the weekly chart of the ES. I went ahead and drew in some trend lines. As I've said in some previous videos, I don't typically use trend lines a lot, but they do give you a visual representation of what's going on, and it helps you break the chart down so that it's not just a lot of candles moving in a bunch of different directions. You can actually get some context to where it is. I really like the weekly trend lines, which those are the dotted lines you see here. I like those for trading because it's the highest level, and I think they provide the most support and resistance, although there are less of them that meet my qualifications. If you want to know how I draw trend lines, I did a video on that previously, and you can see it in the description below. Check it out. Like I said, this is the weekly view of the ES, so you can get an idea. We're going to come back to this, but you can get an idea of where you might want to place your short call and short put just based on this. Let's go down to the daily time frame. As you can see, I have another trend line right here that met my qualifications for a daily, and it's a solid line as opposed to the dash lines on a weekly. Giving you an idea what's going on in the ES right now. I do have a current strangle in place on the ES. What I'm showing you here is on the simulated account, but in my real account I do have an open position, and it's actually getting tested a little bit on the upside right now on the call side, so I'm having to keep an eye on it. But I'm going to go through this trade like we're putting a new trade in place on the simulated, which is what I recommend you do on any trading. As you learn new strategies, is always do simulated. I use TD Ameritrade. I think it's one of the best platforms, not only for charting, but also for its paper trading. So let's go to another screen here and take a look at what's going on in the ES. Now these are my Bollinger Bands, and again, in the description below I show you how to set these up. It did carry over my trend lines so I can see them. Another reason I don't draw a lot of trend lines is because it gets a little confusing when you have a lot of lines going on. But what you can see here is that right now the ES is pushing toward this is the second standard deviation from the mean on the Bollinger Band, and it's pushing this line up. Typically it's going to want to revert back to this mean line here. But it's pushed up a number of days in a row here, and it's made a new high. There's certainly some potential to continue up, but I think 3,100 is a psychological stop for it right now. So I would expect it to consolidate somewhere in this area and at the very least move sideways as this mean catches up, and then it could head up again. It does not mean that it's going to come from here all the way back down to here, because keep in mind, as the ES consolidates, this line will be moving up to meet it. So it may just move sideways a little bit, and then we'll have to see if it breaks through 3,100 and how strongly it breaks through. If it does, then I'm going to have to make adjustments on my live trade. So it's something to keep in mind as we move forward. As we start to look at what would be good entry points for a strangle, typically, I will make them about anywhere, just depending on what implied volatility is. Right here and during this contraction, probably not the best time to have gotten in one. Somewhere in here would have been a better time to enter one. Right now looks like a pretty good time to enter a strangle, because you got the advantage of it being pushed up toward the call side. You're going to get less premium on the call side, so it's going to be closer to in the money. You can get further away on your put side. Just keep in mind is it could drop down into this area, but again, you're going to be further away on the put side, so that's an advantage that you'll pretty much always have on the puts. Will be further out of the money, and the calls will be more in the money. Let's take a look at the other screen. This is my EMA Wave that I also use to decide good times to enter trades. As I said, it's not as important. These particular indicators are not as important on this particular trade, because really what I'm looking at is the price levels, where I expect support and resistance to be, and implied volatility. Those are the most important things, because the higher the implied volatility, the more credit you can get for your strangle. And as implied volatility contracts, the value of your strangle goes down, which means you can buy it back for less, which is what we're trying to do. We're not trying to hold this until the end. We also see right here that RSI is really, really high. If you look at this move up and you compare it to the last chart, where you had your 2-second deviation Bollinger Bands being hit, it really suggests that there's going to be, at the very least, a consolidation here. I also typically expect it to come back into this main area on the EMA wave. However, if it starts to consolidate, this wave is going to move up to meet it. So it doesn't necessarily have to pull back. Another thing just to keep in mind. Now let's look at the rest of the strategy and how I actually put this together. Now the strategy is pretty simple. We're going to go to trades here. I try to look somewhere between 28 to 45 days out. It doesn't really matter to me which one of these I use as far as the week or the Wednesday, the Monday, end of the month. Ideally the monthlies are the best to use, but it's not necessarily a requirement. So for this one, I'm going to go to the December 19, week 2. And what I'm looking for to get my first number that I want to look at is the idea of this trade is to get at least a $4 credit. It could be more, 4 to 5, anywhere in that range would be good. So on the put side, if I'm looking for $2, then I'm going to be at about 27.25. I might be able to get into that for $2 on the put side if I could sell it for $2, which is a little bit in the middle of that. And let's check the call side and see what we got. Where would I have to be? On the call side, I'm probably going to have to be at 32, we're going to say 32.30. So let's go ahead and sell and pull this up. We're going to do a strangle. We're going to do 32.30 for the call, and for the put we're going to do 27.25. So that's showing about a $4.30 credit. Now if I was placing this trade right now, I would probably enter it say in the morning, and I would enter it for maybe a $4.50 credit, and then I would let that sit for an hour or two. Then I would drop it and adjust it until I got down. As long as I get more than a $4 credit, I'm pretty happy. But I want to look at more than just the credit. I also want to see where this shows up on the chart. I'm going back to the original chart I showed you, and I'm going to go to the weekly chart. I want to look at it from a weekly chart standpoint. So the 27.25 is right here. What you see, this is a pivot low. That is to me would be a very good entry point, or a very good short put to have. You know, for it coming back down through here, it would have to break this pivot low, it'd have to break this pivot low, and it would have to break this trend line. In addition, keep in mind this trend line's moving up. So unless it drops straight, it's going to zigzag down. So probably in this area. And so it would also have to break this weekly trend line in order to get to that 27.25 put. That is this is a very good short put position for this type of trade. On the flip side, you know, I'm at a 32.30. Well, my chart actually doesn't go to 32.30. And I also have no upward resistance. So I really don't have anything to go by up on the top side other than I'm just trying to get a $2 credit. So, you know, I'm looking at the distance between where it is now and 32.30, and I've placed these trades before, and I would tell you that that's a typical entry on the call side. So I would go ahead and do the 27.25 put and a 32.30 call, and it would really not worry me that much. So let's say we place this trade and we get into it for $4.30. So you're going to have an initial maintenance, depending on your broker, of about $4,000 to $5,000 that you're going to have to hold as cash against this trade. And that's to cover you in case the worst case happens. Now, technically, you could lose even more than that. But when you initially place the trade, you're probably looking, depending on your broker, between $4,000 to $5,000 that you're going to have to hold in cash just to cover the trade. That can change depending on volatility. With lower volatility, you may have less that you have to have. Higher volatility, you may have to have more. So that's not necessarily a fixed number, but it's just a rough number to keep in mind as you place the trade. Of course, I'm not going to sit by and let this trade go in the money if I can help it. So on the downside, I would probably say if it gets down to about 2,800, I would start looking for an adjustment on the put side. And what that adjustment would be, there's two choices. You can just close the put or close the put in the call and take your gain, loss, whatever you have. If it's a gain, I would just go ahead and close it and keep the gain. If it's a loss and a small loss, I'd probably just close it and take the loss. If it's a little bit larger loss, what you would do is you would roll it down and out. So you would roll from the 27.25 to perhaps a 26.50, just as an example, and you would roll it out a week to possibly 3, depending on how much money depending on how many strikes you can get down, and you're trading time in order to roll this down further. You've also got to take into consideration what the market's doing. If the market's crashing, then you may just be better off closing it and moving on. So that would be one adjustment. Around 2,800, I would start looking at it. If it got to 27.75, I would make an adjustment because that's only 50 points from my short. On the upside, you know, we're at 32.30. So at maybe 31.75, 31.80, I would start really looking at it. And if it were to hit, you know, 31.90 to 3,200, I would make an adjustment. And that adjustment would be up and out. You know, you'd roll it up a number of strikes and you roll it out a week, 2, 3. But you wouldn't just typically roll the call or just the put. You would roll them both, keep them on the same cycle. So just as an example here, let's say you took the 32.30. Actually, let's do the put because we can see it on the chart. Let's say you took your 27.25 put and you rolled it out to say 26.50 for in we'll say 3 weeks. Well, if you adjust it, it's probably trading here. It's around 27.85. So you could roll your 32.30 call down probably even as far as 30.40 and bring in a credit to offset some of the cost here. You know, the idea isn't necessarily to bring in a credit when you roll down an adjustment on one side. So if you have to pay $1, for instance, to roll this put down to a 26.50, but you get a credit of $1 to roll your call down, then it's a net zero. And that's fine. What you don't want to do is have to pay a net debit. So yes, you could pay a debit on your threatened side as long as you get a credit to offset it on your unthreatened side. And it works the same as a call. And that's how I would adjust these. As far as profit target, let's say if I entered this in for $4.30. Well, I'm going to be looking to close that at somewhere between 60 to typically between 60 to 70% of my credit. So if I got a $4.30 credit, then I'm going to put in a good to close order around for 60% at around $2.60. So that I'm not looking to make the whole amount. So if I start out, and let's look back at this trade, let's assume we placed it. Let's go ahead and analyze this trade right here. Risk profile, and this one expired. This one expired December the 19th. So let's set this to December 19. Let's see what our potential. This is the break even. Alright, so you can see we've started this trade with about a 77 or 78% chance of profitability. As I look at this, I probably, just looking at this, would consider maybe moving my puts up a little bit and moving my calls out a little bit further to stay within this gray area, which is the 68% probability range of this particular security based on the current volatility and price movement. So looking at this, I actually probably would adjust this up to more around this range. From the 27.25, maybe I'd do a 27.75 or a 27.50, and that would let me move my call up to maybe a 32.75 potentially. That way I get this gray area within this probability range. But assuming I didn't do that, I'm starting out with a 78% chance of profitability on this. That's if I hold to close. But I'm not going to hold to close. Again, I'm going to sell this at 60 to 70% of whatever credit I get. You could go as much as 50% if you want to. It just increases your risk a little bit. Overall, I would say in the past 2 years, I have only lost money on one of these trades, and it wasn't a lot. Most of them finished profitable. It could be any. I have seen them as few as 7 days, as a matter of fact, to as many as 45 days if I had to make some rolls. Typically, I would say the average time I'm in this trade is 14 to 21 days before it closes. If I do adjust it, I have just a personal rule that, let's say I got in as a $4.30 credit. If I have to defend this trade, then I will try to get out just a little bit better than break even. So I would, instead of trying to make 40%, which means closing at 60% of my credit, I would try to close this one. If I had a credit of $4.30, I might try to close this for a debit of 4. Just because if I've had to adjust it, something's gone wrong and I just want to get out of it. And that's just what I do. That's up to you to make that decision for yourself. Again, if you have any questions, let me know. It's a pretty simple strategy, but it is high risk. And I urge you to remember that it is high risk. You have unlimited risk on the upside or downside if something should go wrong. So you need to know, you need to watch it. You can't just place this trade and forget it. You've got to watch it. You've got to pay attention to it, and you've got to make adjustments if you need to make adjustments. It's not for a beginner options trader. I consider Strangles to be advanced option strategies just because of the risk associated with them. To keep that in mind. And although you have a high probability of success, and most of my trades are successful, when you're trading unlimited risk, it only takes one bad trade to wipe your account. So if you make 100 trades and you're successful 99 times, but that one time wipes your account, well, and that's not a good trade. So keep that in mind if you decide to place these trades. You'll see me on the website posts these from time to time. You'll see me make videos of actual ones I'm doing. I didn't actually place this trade I'm showing you today because I've already got a trade going that I actually may have to defend. That does not happen very often. You know, I only have to defend them once or twice a year, so I have not defended one yet this year. So a little upset about that, but that's just the nature of the trade. Overall, they are highly profitable, but there is a lot of risk, and I just want to underline that there is a lot of risk with a strangle. If you have any questions or comments, let me know. Post them below. Please like this video and please subscribe to the channel if you want to see more videos. Thanks.